Is that, do you think that there's value in using quantitative tools to measure and manage risk?
No, I really don't. We don't do it at all. First of all, what is risk? It's the probability of a negative event in the future. Mm-hmm. What do we know about that? What does the past tell us about that? The past has relevance, mm-hmm. but it's not absolute. And I think that, and by the way, I was talking about epiphanies before, to digress, if I may.
Yes, you can.
So I was writing a memo in 2006 called Risk, and I sat down at the word processor and I wrote what I always believed is that risk cannot be quantified. And that's one of the reasons why I don't believe in models, because risk, being the probability of a bad event, can't be quantified in advance. You can have an opinion, you can state it as a number, but that's not quantification. Quantification is measurement, and the probability of a negative event in the past, in the future, cannot be measured. And then I wrote something, you know, you hit the carriage return, and for the next section, I wrote something that I never thought of before. Risk cannot be quantified even after the fact. You buy something for $1. A year later, you sell it for $2. Was it risky? Any answers? No, you can't tell. Was it a crazy thing where you got lucky and doubled your money? Or was it a really clever thing that nobody else had figured out where you were sure to double your money? And the answer is you can't tell. No, I don't think risk can be measured. I don't think the past is absolutely applicable. In fact, the big money is lost at the juncture when the past stops being applicable, which mm-hmm. happens eventually. And I don't think it can be, I don't think that the possibilities in the future can be synthesized into inputs sufficient to let a computer decide what's risky or not.
I want to just segue to talk about mistakes. So obviously you've gotten a lot right, and we've highlighted all of that. You're also a one-liner, which you're clearly a fan of. I just wanted to share here. Experience is what you get when you don't get what you want.
Right.
When have you ever gotten what you didn't want, and what'd that look like for you?
Well, when I was starting in my career, I'll never forget, I met this guy and he says, we're bringing out two new stocks tomorrow. They were both little tech stocks. Mm-hmm. And he says, and they're both going to double in the first day. I said, good, I'll take it to 100 shares of each. Mm-hmm. And I called them up the next day, a $10 stock. So I bet 2,000. So I called him the next day. I said, what happened? He says, yeah, they both doubled. I said, good, sell one. He said, what do you mean? They're going to the moon. I said, sell one, and I'll take my money out, and we'll let the other ride. So I sold one. The other one, 40, 60, 80, $100, stopped trading. And there was something crooked. Mm-hmm. And when it reopened at 25 or something, mm-hmm. you know, so I learned that there are no sure things. Mm-hmm. And if something, you know, it's one of the important parts of being an investor is to be a skeptic. And, you know, if somebody comes to you and says, I've been managing money for 25 years, I've made 11% a year, I've never had a down month. Your job is to say, that's too good to be true, Mr. Madoff. Mm-hmm. Right? Right? But very few people did. And so I learned the importance of skepticism. And the great thing in life is to learn your lessons inexpensively, mm-hmm. as I did.